All right, I think we can move on to our Your Stock, Our Take segment. Brett is taking a look at MDA Space, a company that we get a ton of questions on, the satellite or tangential market around that satellites are very topical in the markets, and MDA Space had been having a tremendous year, and then they had an announcement this week to start off this week about a contract loss, and that really kicked the stock. So Brett's going to take a look at that.
Yeah, like Ryan was saying, MDA is just one of those companies which we just over and over again just constantly get questions on. So I think today is a good follow up after a big decline. What happened, where they are, and let's see where they're going forward. But MDA, symbol MDA on TSX, if you don't know, it's a leading provider of advanced technology and services to the rapidly expanding global space industry. The company primarily serves the US and Canadian government at this time. The company has three segments: geointelligence, robotics, and space operations and satellite systems. For the first 6 months of the year, the revenue split was about 14%, 23%, and 63% between the geointelligence, robotics, and space, and satellite systems, respectively. And like Ryan was saying, the stocks had a great year so far, but then this last day, we're recording on the Monday, it has fallen 22. And it is now trading at about 34, 33 at the time of recording. And or at the time of writing, and it's a bit lower now when we're recording, around 33. So even a bit worse than that. But it was down about 22% at the price earlier. And that takes it to about a $4.3 billion market cap. And this is really quite a big retracement, even though it's had such a great run up so far this year. It's still up 19% year to date. So still not exactly a dire situation as far as stockholders go if you've been holding it for the year. And even further, 124% over the past year. So it's clearly a high flyer, regardless of the recent drop today. And as well, I will note the last time we covered the stock, Brennan covered it, it was at 27.41 near the start of the year. So let's look at what recently carried the stock price up and what's really caused the decline today. The answer is contracts. The company is driven by large contracts. On August 1st, the company announced that it was selected by EchoStar's, symbol SATS, on the NASDAQ as a prime contractor for EchoStar's new non-terrestrial low Earth orbit direct-to-device satellite constellation. The contract was initially valued at 1.8 billion Canadian for design, manufacturing, and testing of over 100 of its Aurora satellites, with potential to increase over 200 satellites, which would be valued at roughly 3.5 billion. The initial tranche of satellites was expected to be delivered in 2028, with revenue coming in 26 through 29. But that contract just fell apart today, causing that 22 or higher percent plunge. EchoStar canceled the contract with MDA, opting to sell its spectrum rights to SpaceX, the AWS-4 and the H-Block spectrum rights. Effectively, SpaceX can now build the same network that EchoStar was planning to build with its own satellites. This is after EchoStar previously announced on the 26th that it was going to sell those spectrum rights to AT&T for $23 billion US to satisfy the FCC, but that clearly didn't work, so they were effectively forced into selling to SpaceX. This caught MDA off guard, with the CEO stating this is a very unexpected event on a hastily planned call today, highlighting that it is really an unusual event unrelated to MDA's performance. And as well, he reiterated that the company still has a $4.6 billion backlog once you exclude EchoStar, and it has a $20 billion pipeline, of which $13 billion of that is for satellites. But that obviously might not accrue into a proper backlog. But overall, this is a major customer loss with the potential for recurring revenue, and it really a major setback for the company as a whole. It won't impact this year's financial, but it will impact that 2026 through 2029, the previously expected revenue time, and as well remove the potential future sales and recurring additional satellite sales that could have followed on. But let's pivot to some of the recent financials for a minute, with the last quarter being Q2 2025. Revenue was up 54.3% to 373 million, driven by growth in the satellite systems, notably having contribution from the Telesat Lightspeed and Globosat startup. as they start to ramp up, I should say. Gross margin was up to 43.2%, or up 43. I'm going to increase. Gross profit was up 43.2% to 94.8 million, with a slightly lower gross margin by 2% to 25.4% due to the program mix being a bit changed. Adjusted EBITDA rose 56.7% to 76.3 million at an improved margin of 20.4% compared to 20.1%, as the company did see higher volumes, classic economies of scale on the adjusted EBITDA margin. Adjusted net income rose over 100% to 48.1 million, or 38% cents per share. The company is currently in a net cash position, which is great to see. Since when we last covered the company, it previously had been in a firm net debt position, really highlighting that they've actually had positive cash flows over the past year. As well, just to highlight, if we zoom out a bit, we can see the financials, the revenue compared to the backlog. We can see a nice curve of where the revenue shortly follows a couple quarters later the backlog. That's what you want to see when it is a backlog. You want to see that actually convert into real revenue, which you can see clearly just in this simple graph that has been occurring. As I said before, the 2025 guidance as of Q2 2025 has not been changed with EchoStar, as it was expecting in 26 in the future. The company is still expecting revenue of 1.57 to 1.63 billion. That's 48% growth. Adjusted EBITDA of 305 to 320 million at a 19 to 20% margin. That's 45% growth. And CapEx of 210 to 240 million. Obviously, great expected growth figures, which seem to be intact given the first half of the year. It's not a, hey, we guided this, we're not going to meet it. It seems reasonable. Valuations are still, however, a bit high compared to historic valuations. Looking at trailing GAAP PE of 36.5 times, adjusted trailing PE of 27.9, trailing EV/EBITDA of 14.8, and a forward EV/EBITDA off management's guidance figure of 14.6. Elevated compared to historic values, but we have seen some great growth figures over the last couple of years from the top to the bottom line. So you can see why you might value it at more premium. But then on the other hand, now that we see the contract loss today, is that growth starting to slow as a whole, or is this just a single one-off because it is really an unusual event, which I will give them that it was unusual. To wrap this up, major setback with the loss of EchoStar. But the backlog, it's still roughly flat. You're still not losing a massive amount. They're at least refreshing their backlog at a rate that they're consuming it, really. The balance sheet, very healthy with the recent shift to the net cash position of 275 million. Great to see. We always love a net cash balance sheet, so you're not needing to plunge into debt if you do have a nice CapEx opportunity. The valuation's still high compared to historic values, but overall the environment really has improved quite a bit, so it isn't that bad to see it move up a bit in a premium valuation. But you can see what happens when, although out of their hands, I'm going to even attribute this to MDA as more of a regulatory happenstance, that you can see when you have a premium valuation relying on significant growth, which they do have, and they were looking more towards that with EchoStar. If that is taken away, the valuation will just plunge overnight. And that is what we're seeing here. So for now, we'll really monitor for future material contracts. They do have a quite recurring announcements of smaller ones, but we really, if you want to move the needle on a premium stock like this, you do need to have those EchoStar level contracts, those billion-dollar contracts over multiple years, potential for 3-4 year contract periods of revenue, which is great to see. But we do need more of those. We potentially, if you do see a refresh of the GlobalStar satellite system down the line, because they have about 60 of those now planned, do you start to see that get re-upped? Does that occur? We'll have to wait and see. And that's really the crux behind these contract-driven companies, is they're just volatility driven on announcement. You will see them go up and down, and then you have to just wait for those fundamental times when it's trading cheap. The market we will go through a worse economy. It gets cheap. It has long-term contracts in place with governments or large corporations which aren't really feeling the strain. Might be cheap and come on sale, and that could be a potential time to buy. But we'll monitor the company for now.
Yeah, it's a good summary. You highlighted some of the main issues there. I mean, just the risks of any contract driven business, canceled contracts, even those signed, appearing in the backlog, are a real risk. This is precisely why a contract driven business trading at premium multiples is just always typically in our mind higher risk. Something we tend to not invest in. There can be some exceptions, but that would be a general rule. And it would be a better time, like you said, when perhaps the market got to lower valuations on the stock, or it was ignoring it for some reason. Certainly, in a market frenzy, or in a time where you're getting premium mark eyeballs in a sector, it's kind of a time to look away, and it just presents higher level of risk. Now, if they continue to got if the Apple deals come through and this company, you know, gets it one of the, like those, like an EchoStar level contract, like a massive $1 billion contract, maybe you get a run continuing. But this certainly is a kick in the shins for this company, and potentially its growth in the near term and midterm is certainly cut. And then that's why you see a share price cut like that. So we'll watch the stock for the rest of the year. It's something that I'm sure we're going to get further questions on, but we'll probably answer it on the podcast going forward as they continue to report upcoming quarters and new developments. All right.